Hi, and welcome to our today's video. My name is Tim, and I'm the founder of Global Investor Network. Today, I want to talk about options. What options are, what you can do with them, and how you can use them to generate profits. So options are one of two types of derivatives. Derivatives consist of futures and options. Futures are contracts that oblige you or the buyer of the future to buy or sell a certain asset at a future point in time. Vis-a-vis, an option gives the buyer the right to buy or sell an asset at a future point in time. So when we talk about options, usually we talk about options that refer to an underlying asset such as a stock or as a stock index, for example, the Standard & Poor's 500 index. When we talk about options that refer to a stock, we can use, for example, options on Microsoft. We usually divide them in put options and call options. Put options give the buyer the right to sell the stock at a certain point in time for a certain price, the so-called strike price. Call options give you the right to buy a certain stock at a given point in time for a certain price. So when you buy a call option on Microsoft stocks for the strike price of 100, then you have the right to buy one Microsoft share in the future when the option expires for $100. This may be good or bad, depending on what price Microsoft stocks have at that point in time. For example, if you want to make sure that you are able to buy Microsoft shares at a very cheap price, you want to buy a call option with a strike price of, say, 50. And if the stock price of Microsoft happens to be at 100 when the option expires, you actually make a profit of $50 when exercising the option. Because then you have the right to buy one Microsoft share for $50 and can sell it immediately at the stock market for $100. So you make a net profit of $50. On the opposite, you have to pay a certain amount for buying the option. So let's say, for example, an option costs you $5. So the total profit would be $45 in our example. On the other hand, if you buy a put option, you acquire the right to sell a stock at a certain point in time for a given price. And then again, you can make a profit if the actual stock price is below your strike price. So let's say you buy a put option with a strike price of 100 and the price of the underlying share is 50, then you again make a profit of 50, net the price you paid for the option. If you exercise the option and immediately buy the share back. So in total, to sum it up, options give you the right to buy or sell a stock at a given point in time for a certain price. They have an inherent risk in that if the stock price is out of the money, which means that you will not make a profit if buying or selling the stock in form of exercising the option. This means that the option simply becomes void, you would not exercise it, and you just have paid the price you paid for the option. So you make a little loss in terms of the money you paid for the option. But then again, you don't have the risk that you actually have to buy or sell the stock. So they are a very good way to gamble a little bit. If you want to make huge profits with only limited investment, you can buy options. And they give you the opportunity to trade the stock market in a very efficient way and can generate very high profits with only limited exposure. So I hope you enjoyed this video. If you like it, please follow our YouTube account. Please like this video so that we can bring more interesting videos to you in the next time. Thank you very much.